This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it's the jaunty Rob Reinhold.
The jaunty. I like that. I'm going to have to change a lot of my behaviors in life to be jaunty. No one has ever called me jaunty before. But I appreciate being here. It's always fun talking about trading psychology. And look, this one is near and dear to my heart. So let's get going on this. I love this one.
Yeah, so what we've been doing, if you haven't been with us the last couple of weeks, is going over the psychological advantages and disadvantages of certain markets. So we covered Forex and to a lesser degree crypto. We talked about stocks last week. And at the very end, Rob kind of teased that, at least over at Maverick, they trade stocks and options both in this type of weird synergy. So maybe we'll get a little more insight into that. And then talk about the psychological advantages and disadvantages here, and to really discover for ourselves, if you don't do this now, might there be a really good and reasonable opportunity for you to do something like this going forward? Would it make sense? Is the juice worth the squeeze? Whether that answer is yes or no for you, we will certainly have all those questions answered by the end of this episode. So, Rob, this is probably going to be 95% you. I am okay with that for this episode because I just don't know a whole lot about this, so I'll be learning along with everybody else.
Well, thanks, Patrick. And I need to start off this episode with just coming out and disclosing. This episode is going to sound like I've been hired by the Options Clearing Corporation to be a paid shill for options trading. Now, again, I don't get a dime if you options trade it. I don't care if you options trade. But I'm going to share with you how this one change I made in my trading early on fixed most of my psychological problems that I was having as a stock trader. So options are near and dear to me. But in the end, just like we talked about in the last couple episodes, trading is trading. Driving cars, driving a car. Yes, options are a little bit more complex. They've got a little bit more rules. But in the end, guess what they are? They're a symbol. Now, I've been saying they're a symbol and they go up and down based on the supply and demand. Options are a derivative. Whenever you hear the word derivative, it means that their value is derived by something else. So the option price does not go up and down based on the supply and demand of the option. It goes up and down based on the supply demand of the stock. And the option is a derivative of that price. So if the stock goes up in value, calls go up in value and puts go down in value. If the stock goes down in value, calls go down in value, puts go up in value. So it's just like kind of long and short with calls and puts. But in the end, it's a symbol. The stock will go up and down based on supply and demand. You can learn how to trade it. Now, when I was a young trader, I've always had some things I did very well. One of my biggest strengths as a young trader, I was really good at holding winners. I was really good at it. And when everyone else got out, I was squeezing more and more out of winners, and it really made a difference on my profit factor. So those are some of the things I did really well. I was really good on some timing. I was really good on seeing changes and trends. There were some things I did really well. But the things I did not do very well was position sizing. I would have too much of my capital in any one trade. Why? Because I wanted to make $1,000. If I did proper position size, I would have made $100. So I wanted to make that money. And then the other thing was I was pretty good at risk management, meaning getting out of losers. When I started out, there were no automated stop orders. You had to have a mental stop. A mental stop. Think about that. Where, hey, I bought the stock at 100, but if it goes below 98, I'm going to get out. I would say that 9 out of 10 times I could click that button at 98. Here's the problem. 1 out of 10 times I couldn't. 1 out of 10 times I would blow it. And then when we got automated stops in like 99 is when, automated stops are here, great. I would find myself canceling those automated stops. Patrick, have you ever done that before in your early years? Had a stop out there and cancel it? Because I don't think I want to get stopped out of this one.
No, of course. Yeah, like especially if you've already taken a couple losses, you're like, man, I don't want to take another full loss. That's going to hurt. So let me just chicken out and back out now.
Or the market does the thing that happens to everybody. You have stop orders in, and it runs down through your stop. You get stopped out, and then it runs back up, and you would have been fine. You would have been profitable. Once that happens to you 3 times in a row, it's really hard to leave your stop out there on the 4th time, because you've just been programmed that you don't need that stop. That stop hurts you, and it's going to come back up. So look, all these psychological problems got it to where I could follow my rules 9 out of 10 times. 1 out of 10 times I couldn't. And that 1 out of 10 times usually created a loss that wiped out my big gain that I could get. And so in the end, I was treading water, making a little, losing a little, but I would have these big spikes in my account. I'd have big runs and then big spikes down, big runs and then big spikes down. And it wasn't a smooth equity curve. One of the things we talk about at Maverick is your equity curve. What that means is your account value over a 1-year period. So I love to look at traders' journals that have some data in it, because I want to look and see how big were the drawdowns, how big and how deep were they. That determines how much capital I want to allow them to trade, because I know they're going to take, if this trader's taking 40% drawdowns, I'm going to have a hard time giving that trader $250,000 and having a 6-figure drawdown. That's going to be really tough for me to do. And that's what my equity curve looked like, because 1 out of 10 times I blew it. Once I learned and got into options trading, this fixed it. And the biggest advantage number 1 to options trading is absolutely guaranteed risk management. Let me give you a quick example. I know that some of you aren't going to know a ton about options. Some of you are going to know quite a bit. I'm just going to give you an example. You can buy a call option. A call option is the right to buy the stock. So let's say there's a stock at $100. I can buy the option to buy it at $100. And that option is going to cost me $2 a share. So, and every option has an expiration date. So let's say this option expires in 2 weeks. So 2 weeks. Anytime during those 2 weeks, I can buy the stock at 100. If the stock runs up to $110, I can buy the stock at 100, sell it at 110 immediately. Or I can sell my option for $10. It doesn't matter which one. But here's the great thing. Let's say this company comes out and their product has been killing people, and that stock drops all the way from 100 down to $10 a share. The most I can lose is $2. I don't have to have a stop. Again, those stop orders. And I know like a lot of your traders are Forex traders and you have to use stops in Forex. Trust me, I've played around with all different strategies, and stops are the most effective way to do it in Forex. In options, you can completely quantify your risk on any trade. So if you bought 2 contracts of that trade, you had $400 at risk. That is worst case scenario. And here's the cool thing about options. Let's say this company comes out with a bad earnings report. And let's say the company drops from $100 down to $85. But then people have had a change of heart and they buy that stock back up. And 2 weeks later, that stock's at $105. That happens all the time in the market. You were profitable on that trade. If you had a stop, you would have been a loser on it. So what this allowed me to do is basically to not have any position management. I would buy that option for $2. I would let that stock go against me $100. It didn't matter. It didn't matter how much it went against me. If by the end of the options period, it was above 100, I would have some money in it. If it was above 102, that would be my break-even point. 102, that would be a profitable trade. So for the first time, I didn't have to make a decision on when to get out of a trade. I didn't have to decide, should I pull that stop out of the way? I've just taken a couple losses. I don't even have the ability to do that. I'm looking back at my trading career. And again, I was working on my psychology. I was doing better about not blowing it, but I wasn't there yet. When I found this really allowed me to really have to not fight that psychological battle. So any of you that are having a really hard time following your position management rules, I'm telling you, options are beautiful because it's just a guarantee. It's just you price it for max risk and you let it go. You let it go.
So probably the main reason why I never really explored options or was never really interested in them is I never wanted to be constricted by a set amount of time. But I also never really considered the advantages of that. So what you're saying is if I put in a call option at $100 and I set it for, my losses if it goes down to 95, even if we have a flash crash of some sort, and if I would have had a regular stop order there, like it went so far beyond it didn't even get triggered. You just had a massive amount of slippage, and it took that price all the way down to $70. Not only do I only stand to lose $5 no matter what, but if for some miracle over time, in that period of time that I need to wait, price would come back up and maybe even put me in the black, that once that time period ended, I would actually make money?
That is correct.
Okay. Well, that changes things a little bit because that's a really great thing because so many people, for one, worry about gaps, but you're saying in this situation, gaps don't matter at all.
They will matter, but it will be a very small mattering. As long as your position sizing is correct. Like in your example, if you did one contract at $5, that's $500 at risk. That's your risk. The stock could go to zero, and that's your risk. Let me tell you another positive about options. So that was an example of a long call where you bought the call. Let me give you an example of a short call. Now, look, I am not advocating anyone go out and sell a naked option. There are much, much better ways to do it, but I'm going to show you this example of the option. So Patrick, let's say that you wanted to buy that $100 call for $5, but I wanted to sell it to you for $5. So let's look and see on opposite ends of this transaction. Neither one of us own the stock. We're just betting on the direction. If your stock goes up to 110, you're going to exercise the stock, buy it at 110. I don't have the stock, so I have to go buy it at the market at 110 and sell it to you. You gave me $5, so I'm going to have a $5 loss. Do you see that? Because, you have the right to buy it for 100 from me. I had to buy it at the market at 110. However, let's say the stock didn't go up. Let's say the stock went down. Let's say the stock closed at $99.50 on that expiration date. Do you want to buy the stock from me at 100?
Well, at this point, no.
So you lose your $5 and I made your $5. That's selling an option. So as you can see here, selling an option is what we call a bidirectional trades. If the stock went down, I made money. If it went sideways, I made money. As long as the stock didn't go more than $105, I made money. That's a great way to make money in the options world. And most professional options traders, they do more options selling than options buying. Now, the reason I say I would never advocate anyone to sell what that's called sell the naked call, because Patrick, what if that stock gets bought out for $200 a share during our transaction? Are you pretty happy about that?
I would be, but did I already kind of cannibalize my earnings by setting a certain take profit point when I made this call, or how does that work?
Well, it was a gap. No, it was a gap. So it gapped right over whatever your limit price was. It gapped right over it because the market was closed. So your option would be worth $100. The one you bought for $5 would be worth $100. Here's my problem. I'm screwed because I'm on the hook to sell it to you for $100. I have to go to the open market and buy it for $200. My risk is theoretically unlimited. If that stock goes to 4,000, I'm on the hook. So that's why selling a naked option is not a good idea. You cannot quantify your risk. And the reason we love options is you can quantify your risk. So here's what we do. Could I go and buy a $110 call from the market to protect myself?
You're asking me? I'd imagine you could. You want to hedge, right?
Yeah, yeah. So now, if it costs me $1 to do that, I'm now on the hook for $6 because again, I'm only gonna have $4 in my pocket. You gave me $5, but I paid out $1, so my break even is now 104. But over 110, I can't lose any more money. It allows me to completely quantify my risk, and I'm not even betting the stock's going up. I'm just betting the stock's not going up. It could go sideways, and I'm going to make all that money. It could go down, I'm going to make all that money. So one of the big, huge advantages of options trading is that in all other styles of trading, Forex trading and stock trading, futures trading, you have to get a move in the direction that you bet on. That's called directional trading. And directional trading, you've got to have good timing. You've got to have all these things. Doing this with options, being an options seller, do I even need good timing on this trade, Patrick?
Not really. I mean, maybe maybe a little bit, but less so than you would elsewhere.
I need to just make sure that by the expiration date, that stock's under $100. If it is, I'm happy. I don't have to have good timing. I didn't have to get into the right time and out at the right time. I'm just saying, I don't think this stock goes above 100 for the next 2 weeks or whatever the time frame was. That's my bet. So this is what's called positive theta. You're making money off of time decay, not direction. This is where, again, options are great. In sideways markets, you can make good money in options. In sideways markets, Forex, stock, they become difficult to make money in. Very difficult, especially if you're doing a trend trading strategy where you're trying to get these things to move. When the move is choppy or when the move is non-existent, options trading gives you a great way to actually make money in those markets.
Well, that's a nice little choice to have. I'll say that because if there's any enemy to what we do, it is sideways markets, either just because we're sitting around doing nothing or it's a choppy sideways market and we're getting stopped out. So okay.
Well, Patrick, let me tell you a cool thing. Again, there are options on currency futures. So you can trade options on currencies. Now, it's going to be on the currency futures. I don't know how much you talk to your listeners about currency futures. I'm not a huge fan of currency futures, but if you understand Forex, you can actually trade options on Forex. There is also some stock ETFs that follow Forex. So for example, the FXA is the symbol that follows the Aussie dollar. You can trade options on the FXA. So you could do options trading on your Forex trades. It's not going to be in the spot Forex market, but it's going to, again, be a derivative of that. There's lots of cool things you can do here.
Yeah, there are people who actually trade FX options quite a bit because I get questions from them a lot. So I know they exist, and so I know that market exists too. But in the United States, yeah, that's how I always get around things like that. UUP is the one for the dollar. So you can it's really not very volatile, but you can play with that one too. Now, okay, so before we get too deep in the weeds here in terms of just explaining how this works, I think you gave a pretty good primer, at least about the major advantages to how the overall mechanics of it work. But let's proceed on from here because I see you got quite a bit here, and I don't want to make this into an options course. So are there any other advantages, clear advantages, that you can think of before we get into the disadvantages? Because I like what I'm hearing so far on the advantage side.
There are so many cool things you can do. One of the things that scares a stock trader, and rightfully so, and a Forex trader is news events. News events because you know there's going to be volatility. And if you have a stop anywhere near market price, you're most likely going to get stopped out. Even if you were correct on the eventual destination of the currency, you got stopped out because of the chop of the volatility. Options give you the ability to really just sit through that because, in your example, you bought the $100 call for $5. You bought one contract, you got $500 of risk. Patrick, would you be scared to stay in that stock over an earnings report when the stock's at 100?
Yeah, I would just bail. I wouldn't even bother.
Well, you would bail because the future is uncertain. The future is uncertain, so you say, you know what, since it's so uncertain, In other things, you have equal risk and equal reward. So in currencies, let's say you're trading a currency that's at, let's say $1.20. And in that event, it's either going to go up to 125 or 115. Your risk is equal. And I would absolutely say, get the hell out of there. If you don't have an edge going into that news event, get out of there. Here's the crazy thing about this option, though. What is your downside? If the worst case scenario, what's going to be your loss on your option?
I don't know. Well, I guess whatever I set it to be, right?
Yeah, $500. $500. If you bought a $100 call for $5, one contract of that is going to be $500. What's your upside potential?
Well, the way you put it, like I thought it was limited, but apparently it's not.
No, if that stock goes up to $120, your $100 call is worth $20. So we're putting ourselves in situations of asymmetric risk, which is very, very beneficial. Like if someone came to you and said, hey, Patrick, I got this game. We're going to flip a coin. Heads, you win $20. Tails, you lose $5. Would you ever stop playing that game?
Never. I would sell body parts until I just started winning, which over time I eventually would.
All right. Now, before anyone gets excited, that is not how the options market works. You do not get a 50-50 chance to make 3-1. That's
okay, I was going to say, because I'm like, okay, why didn't I start doing this 20 years ago? There's got to be clear disadvantages to this market. So let's weigh them out here.
The best way to really understand options trading, again, a long call or a long put, is in sports betting. And I know, Patrick, you've done a lot of sports betting. Buying an option is the over-under bet in sports betting. So a lot of people think, okay, well, if I'm buying a call option on Microsoft, if it goes up, I make money. If it goes down, I lose money. No, that's not true. You're not trading the line. You're not trading, win or lose. You're trading the over-under. They know, again, in a sports event, so let's say the Cowboys are playing the Eagles. I'm going to upset some Cowboys fans here, but let's say the Eagles, actually, no, this isn't, the Eagles are going to win, but they have to win by 3 for you to cover the spread. That's the spread, it's 3. So in options trading, sorry, I shouldn't say over-under, it's the spread. You're not betting that Microsoft is going to go up. You're betting that Microsoft is going to go up more than the spread thinks it's going to go up. Does that make sense?
It does now. You said over-under. I'm like, what? Every trade is an over-under. But yeah, okay. Now that you're saying the spread, so it has to go up by a certain amount, or else a particular amount, or else I don't make money, right?
Correct. And if it doesn't go up by that amount, the option seller made money. So for the example we're doing, I sold you the option. If it doesn't go up more than $5, I made money. It had to cover that spread. So every option has a spread in it. So going into that news event, there is a spread. Like the stock will have to go up more than higher than like $108 for you to break even on the trade. Here's the cool thing about options. There's lots of cool options software that literally tells you these things. Hey, your stock has to go above $108 at earnings for you to become profitable. And then you get to make a decision on whether you want to make that trade. It's very, very cool. But here's the great thing. Again, you can really trade through news events. You can do anything you want because you've quantified your risk. Your risk is guaranteed.
Okay, so I knew there was a catch somewhere. So that's one of them. Are there any others that I need to be aware about before making a decision? Because again, it's a big decision. It's a big time decision. I got to relearn things all over again. I want to know everything I can. So be honest. What else, on a disadvantage standpoint, do I need to really keep an eye out for?
All right, that was my paid shill part of the of the options here. Let's get real, because it's not an easy game. It's not any easier than anything else. It's just a game. Now, all options are priced to 0 expected value over 1,000 trades. Now, I'm going to go back into the sports betting arena. Patrick, if you just bet on the spread, if you just took the spread number, or you took half the trades you took under the spread, half the trades you took over the spread, what would your expected profit be at the end of 100 bets?
Minus juice, it would be break even.
Exactly. Minus juice. It would be break even. That's how it works in the stock market. The stock market runs off of the exact same math that runs off of. So there is no edge in options trading. And so some of the examples that I gave you earlier, if you got all excited, I'm going to dash those because there is no edge. It's just like sports betting. There is no edge. You have to be able to beat that spread. Now, everyone gets into options, buying options. And I gave you that great example of buying that call at $100. If it goes to zero, you lose $5. If it goes to 200, you make 200. The problem is those options come with time decay. So if you are a 50-50 trader, 50-50 win-loss, and you get into options, you're probably going to be at 35-65. Why? Because your options premium is always expiring. It's always decaying. And as you get closer and closer to the end, they decay very rapidly. When most people get into options, they look at this stock and they say, oh, here's a stock. It's on Tuesday. The stock's at $50. I think it's going to be at $55 by Friday. So they'll buy the option that expires on Friday, and they'll buy it for $3. If that stock is to $53 on Friday, they've broken even. So do you see how difficult of a trade that is? You have 4 days. You got to be perfectly right. And it has to go up by at least $3 just so you can break even. Would you ever take that trade?
Well, no, but I don't have to take trades like that, do I?
In options, you do. And that is the options trading market. So again, you're not betting on the win or loss. You're betting on the spread. Every single trade has a spread built into it. And people that don't understand that, they're always getting this drag. And so, again, their win-loss is terrible. It's terrible, and it causes them to, get into the downward spiral and do all these dumb things. And we also know that people are really bad at holding winners. So the reason you would do a trade like this is because you want these outsized winners, and you want to keep all your losers very small. The problem is people are terrible at holding their winners, especially in long calls. So look, there's always a drag. There's always a drag. There's always that spread that you have to beat when you're in long calls and puts. Now, as you said, I don't have time for this to become an options class. We do mostly spreads at Maverick, where you're long one option, short another, and that really gets rid of a lot of that negative theta that goes against you. So we're just trying to isolate certain things. The second disadvantage is liquidity. Now, this is where options are really crazy because an option price can change even if there's not a trade. Now, in Forex, that really can't happen. The only time Forex can go up is when people buy more more amount that's available out there on the ask, and it goes up to the next ask. So there has to be people buying those stocks, currencies, for them to go up and down in price. Remember, options are a derivative. So if the stock goes up, the price of the option goes up. If the stock goes down, the price of the option goes down. Here's the problem. When people go out and put stops, the default is last trade. So think about that. When you put a stop in on Forex, so if you're in a currency and you put a stop in at 120, it is triggered as soon as a trade goes off at 120 or lower, your order automatically goes out. Could your price of your option go below your stop and never have a trade? The answer is yes. The answer is yes. So stop orders are pretty lousy on options. The bid-ask spreads, when you're looking to buy an option, the spread will be like $1.50 by $1.90. 40 cents? That's like 20%. That's insane. You're just losing 20% on a bid-ask spread. If your spread is 80 cents by $1, that's a 20% spread. You can't overcome those numbers. You have to have a crazy win-loss and crazy profit factor just to overcome those numbers. So again, the bid-ask spread is no joke. There are ways that you can handle these, but you really have to know them. But there is not good liquidity in options. Now, obviously, the most highly traded stocks will have the most highly traded options, but there's still it's bad liquidity in options.
Okay, so that's not great, but it does sound like something you can overcome or at least mitigate to a degree. So, all right, so before I weigh both of these out completely, are there any other disadvantages that we need to know about?
Yes, and I'm trying to think of how I can explain this without going deep into options. There are things called options Greeks, and Greeks are the things that affect the price. Delta, and again, a real quick crash course on Delta. If you buy an option that has a delta of 50.50, what that means is for the next dollar your stock goes up, the price of your option will go up by 50 cents. That's delta. So when a stock goes up $1, very rarely does your option go up $1. It goes up by 50 cents. And when it goes down $1, your option goes down by 50 cents. So delta is basically the percentage move of the option in comparison to the move of the stock. There's all these other Greeks. Theta, we talked about. Theta is time decay. And theta is just a mathematical formula that every day you hold an option, it loses more and more and more of its value and it accelerates at the end. So you have to know about that. There is one Greek that is the absolute wild card. And everything else in the stock market, look, nothing is predictable, but you know that if a stock goes up from $100 to $101, you know that moved $1. And like you know, there's some things you just know. Like, you know, when your delta is 50 and the stock goes up $1, you know your option is going to go at 50 cents. You know that. Implied volatility is the market's measure of people's emotions. It's their behavior. When markets freak out, we see big moves in price, but what you don't see is the absolute insanity that happens in implied volatility. And of all the things in trading, this is the absolute most difficult, impossible thing to get right, and it's going to do things that completely blow your mind. And I'm going to give you one example. In May of 2020, we had the price of oil was negative $37. Do you remember that, Patrick?
I do, and I wanted to buy, but I just didn't know if I was able to because I've never seen anything like that before.
Nobody had ever seen anything like that before. That was implied volatility. I'm going to explain exactly what happened. But everyone's theoretical models did not go negative. So there were like really high level traders who had all these theoretical models. They've had to reprogram those models to even understand that negative $37 oil is even possible. Before then, it wasn't even possible. That happened because implied volatility. And what happened was, this is something called contango. So if you took a look at the options, sorry, not the options, but this was the futures market, the oil's futures market. Every single month has a different futures attached to it. It was only the May futures. The May futures were negative $37. The June futures were positive $25. And then the July futures were positive like $28. This is what implied volatility can do. So when you're in options trading, one of the values to the option is implied volatility. And it's crazy. It's really crazy. And there are times where if you are in more complex option spreads, your theoretical what should have happened does the exact opposite. So again, like I said, it's to someone who's really experienced with options trading will get this, but I really wanted to balance this out because I was an absolute shill about options trading in the first half of this. I want to definitely make it clear that options are definitely more complex when it comes to trading. So there's a lot to think about, but for me, it solved my psychological problems. And I got away from stop orders, which I couldn't quite keep all the time. And then it allowed me to get the discipline to when I went back into a market like Forex in 2007 to trade stocks, I had built the discipline to not pull orders, to not screw it up. And I really happy about that I didn't get started in Forex right away, that I could build this discipline through using options to basically get myself out of having to fight my battles that I was constantly losing to where I could then understand more of the process.
So then overall, and I'm glad you tied it back to psychology, because sometimes we get too in the weeds here and we get away from that sometimes. But given all of those things, to the average trader who listens to this podcast, would you recommend this to them, and why?
Let's take this the same way we've done the other episodes on the disadvantages and advantages of different trading products. It's all dependent on the person. We talk about your lifestyle. We talk about your personality. Some people won't enjoy options trading. It just won't be interesting. It won't be fun. It'll be too complex or it'll be too messy. Some people, their lifestyle is more suited to other markets. Look, this is where it's simply a way to trade. It's not the best way. There is no best way. What there is a best way for you. So I always recommend to everyone, I love knowledge, and I think learning new things is only positive. It's only positive. Learn it, see if you like it, and if you don't like it, throw it away. There's been a lot of things I learned. Heck, I studied Elliott wave theory for well over a year, and I pretty much threw it all away. But I'm glad I did it. I'm really glad I did it because it did help other parts of my trading. I just don't use it at all. So my advice is learn about it, see if it works for you, and if it doesn't, throw it away.
Yeah, I'm really glad you said that too, because I've told this story before as well. I spent a year learning ICT's method of price action. And while I never really picked it up and I didn't like it because I couldn't test it, I'm super glad I spent that year learning it, because portions of it carried over and became pivotal features and factors in the way I trade now. So I might, just without knowing this as much as you do, Rob, I might recommend this to my traders as well, because my traders typically, if you're going to spend as much time as you did to learn my system, you're probably set up to learn something like this pretty well too, because you're very detail oriented. I still get questions from people who are just maybe, like 20, 30% into this. And it's a really nerdy, deep question, and it's kind of annoying, but I always try to answer it because all they're really trying to do is follow this system to the letter, and I really appreciate that. So I have a feeling a lot of you are that way too, so you would probably be pretty well equipped for something like this. This does not seem like a trading method for people who want to take shortcuts. Is that fair to say?
Yeah, that is absolutely fair to say. When you're learning to trade Forex or stocks, it's directional trading. You literally are just worried about doing direction. In options, you've got delta, gamma, vega, theta, and the rho. You've got 5 things to learn. They all affect where your trade's going to go. So yeah, I would definitely put this on the back end of what you should be learning.
Good. Well, good to know. I mean, I know this is an episode that not a lot of people probably expected, but I really do think now that I've kind of listened to all of it, it can be really helpful to people, especially if you're maybe looking for another challenge, and a challenge that, like you said, Rob, overall can cascade over and benefit you in other ways of trading. So anything else you want to say, Rob, before we wrap it up?
Yes, I want to bring it back to Forex because like you said, this episode probably for some of you is like, okay, that's nice to know, but that doesn't really apply to me. If you know things, imagine you are in an Australian dollar, US dollar position. You're long Aussie dollar. And you're coming into a Fed, you really like the position. You've got a nice profit on it, but you're not going to risk holding it over the position. Could you sell out your Forex position, go in and buy the call option on the FXA and totally quantify your risk to where, again, you bought one call option for $1.50. That's $150. So let's say you've already got a $500 profit. You wanted to hold it, but it's just too much risk. You're willing to risk $150 of that go buy the long call on the FXA. It gives you a lot of things you can do with your trading. You can just use this in your Forex trading every now and then. Again, if you know it, you know how to use it, you can decide when it's applicable to you. So I'm a big fan of just learning as much as you possibly can in your life. And if you're going to be in the world of trading for your life, learn it all. Learn it all. You got time.
I'm with you on that. If it's useful and it's something you can carry with you in a positive way for the rest of your life, absolutely learn it for sure. That goes for cooking, sewing, like any useful life skill like that. For sure, I'm with you. So I guess on that note, traders, thank you for joining us here.
Have a good day, everybody.